Top bankers talking about the RBI policy, which has delivered, but markets have not responded well. We'll talk about markets in greater detail, but first, here are the Dabur numbers. Sunil Duggal, CEO of Dabur, has joined in. More on the RBI policy will follow at 3 o'clock. Sunil, good afternoon. Thanks for joining in. Your sales growth at 12% first. Can you just break it up between volume and price, and whether it's a bit lower than your expectations, a bit more sluggish?
Well, the headline numbers do look a little low at first sight, but if you drill down, you will find that the domestic consumer business is growing at 14.5%, and that is really the chief generator of profitability. And this 14.5% can be broken up into 9.5% volume and 5% price, which again is a healthy sign. So the volume growth remains close to double digits, which is pretty robust. There has been some pressures on our commodity export business, which has dragged down top line, but that is really not strategic. So we don't worry too much about that. So overall, I think it's been a strong performance at the top line, and even better so as far as the margins are concerned, with the EBITDA growing at 20% and profit at around 22%.
Hi Sunil, good afternoon, and thanks for joining in on the show.
Hello.
In your operational performance, your ad spends continue to be much higher than what you've guided for in the past. What kind of a run rate do you hope to maintain in terms of ad spends, and how much do you think you could bring it down to?
I think we would probably moderate ad spends a little bit as compared to what you've seen in this quarter. I don't think there'll be any major reduction, but there will be some moderation. So maybe we'll try to manage with 50 to 100 basis points lower than what we've done this quarter. A lot of our launches are now coming through, and while they would be pretty expensive in terms of media spends, we do believe that we have invested sufficiently over the last few quarters in existing brands, so we can moderate spends a little bit. So we'll try to moderate spends here and let the additional profit flow through, but I won't really bet on it. Let's see how the competitive environment pans out.
This 9.5% volume growth, which categories are the leaders and which are the laggards in that, and do you expect to maintain this kind of near double-digit volume growth, or some moderation to creep in the next 2 quarters?
Well, to answer the second part first, we do expect volume growths to remain in the 8 to 12% band, and that's what we guided earlier. And that remains. So we'll try to cross double digits, but it's never easy going. So even the current volume growths of around 10% we believe are pretty satisfactory. And the key drivers of growth this quarter at least has been foods, as always. Foods the last 3 or 4 quarters has been extremely bullish in terms of growth. But HPC, which was perhaps a little bit of a drag the last couple of quarters, has recovered very strongly. So we've seen 30% growth in shampoos, around 15 in perfumed hair oils, another 13-14 in oral care. So overall, very strong delivery by home and personal care. Home care part has grown at around 30-odd%. The healthcare has been much more moderate at around 10, but overall foods and home and personal care have been the key drivers of growth.
You've spoken about your domestic consumer business. What about exports? Because the argument there is that exports are growing, but it's on a really low base. Have you been able to take any kind of price hikes in the export business, and what kind of volume growth do you think you can sustain there?
Actually, there's not much exports we do of branded products. We do export some commodities, which was significantly lower this quarter, which contributed, like I said earlier, to the shortfall in our top line. But our overseas business is basically manufactured in the countries in which we do business in, and the margin expansion there was actually quite good, particularly in our organic business, which is hubbed in the MENA region, Middle East and North African region. We didn't take any price increases there because the commodity environment was very soft, so we didn't need to take any increases. It was almost entirely volume driven, and we saw very good growth there, as well as huge amount of margin expansion. Then the acquired businesses were a mixed bag. The business in Turkey, which we acquired a couple of years ago, did well. It's turned around, showing 20-odd% top line growth, and the margins are also creeping up. I think the only point of pressure remained the domestic US business, which was significantly underperforming. There has been major changes in terms of brand architecture, in terms of distribution arrangements, management changes, etc., which has kept performance there for this year pretty subdued. We do hope to regain momentum there by next year, definitely early part of next year. So that's been really the only weak spot.
Okay, Sunil, all the best for the quarters to come. Thanks so much for joining us. That's Dabur, 9.5% volume growth. So it continues its volume performance, unlike its peers like HUL and Whirlpool, who have indicated a significant slowdown in discretionary consumption. But for the market, 6,059. So it's down about 0.2%, an anti-climax, you think, or in line with what the street was expecting?
No, if you'll remember in December, exactly the opposite happened, Sonia.